As an investor, you no doubt like to make money, but you probably dislike losing it even more. And that really could be costing you. One of the biggest pitfalls investors face is what academics call myopic loss aversion. So what exactly is it? Here's Joe Wiggins.
All it is we worry a lot about short-term losses, and even if we have long-term goals, we sometimes make decisions just to protect ourselves from those short-term losses.
If we think about when we make an investment, then there's always the potential for loss and the potential for profit. Now, when we make a profit, we know that feels good, and equally, when we lose money, we know that that hurts. But here's an interesting question. Imagine if I asked you to look at your investment portfolio. You haven't looked at it for a while. You open it up and on one day you see it's made a loss of 20%. And hypothetically on another day you look at it and you see that it's made a gain. Now the loss in dollar terms or in pounds and pence is exactly the same. But the reality is for most of us that it doesn't actually feel the same. The loss hurts more than the gain.
Like all of our behavioural biases, loss aversion has its roots in our evolutionary history.
In a state of nature, if you go out hunting and you make even a small mistake and take home half as much meat as you should have, you and the other members of your tribe are going to starve to death. So you tend to overemphasize the importance and feel the emotional impact of small losses. Whereas, in the stock market, that's actually something that should, if you're rational, should excite you. If you can buy something at half off, that's what you should be doing. But people's first emotional response to losing money in a given asset class or a given asset is to sell it. They want to distance themselves from the pain. And again, that just goes right back to our evolutionary psychology, to our evolutionary background.
If we think about our evolutionary history, for most of the time, we had to take risks to get rewards, whether that was going into the forest to do some hunting, trying to move out a competing tribe from where we're at. And we had a very clear but subconscious way of accounting for risk. And importantly, in our ancestral environments, then there were no safety nets. So the risks could hurt us far more significantly.
Of course, it seems perfectly reasonable to dislike losses. What's the problem? Here's Joe again.
The problem is, if we're investing for the long term, we probably want to invest in the stock market, in equities, and over the short run horizons, they can be very volatile and suffer from bear markets, from panics, from drawdowns. And to enjoy the long-term benefits of investing in assets like equities, we need to be able to withstand those short-term losses. But often we really struggle to do that, so we don't capture those long-run benefits and returns. So it's really interesting if you think about equity markets. The longer your time horizon, the more confident you can be in generating a strong return. The problem is that over short horizons, let's say over one day, it's a coin toss whether equities will be positive or negative. But as we extend that and we move into genuinely long horizons like 5, 10, 15, 20 years, then we're much more likely to generate positive real returns. Using other asset classes like bonds can insulate us from some of those difficult short-term losses and make us more likely to succeed over the long term.
One of the things that we see is that sometimes we can miss out on really good investments because we don't think the return is good enough for a reward. A second thing that we can often see is that when we've actually lost some money on an investment or maybe our house, then we're tempted to hold on to it until it returns to profit. We just don't like that feeling of loss. But it can also be flipped the other way. Perhaps we've made a profit on an investment. We can sometimes feel the need to actually lock in that profit, potentially missing out on a lot of upside. So these things can be a useful guide for us, but they can sometimes drag us in the wrong direction as well.
Loss aversion can be extremely costly. Not investing enough because you're worried about making losses, or bailing out when markets have fallen, can have catastrophic consequences.
It can absolutely destroy your long-term investment results. A lot of people sold out at the bottom in 2008 to early 2009. When the market passes its point of maximum pessimism, the gains that are made are absolutely enormous. So if you are not invested during those periods of time, you're going to lose out If you weren't invested for the year following March 2009, you lost 50% of your investment returns right there.
Behavioural biases are hard to deal with, and loss aversion is no exception. But there are things you can do.
Get good professional advice. I think we all recognise that it's easier to solve other people's problems than our own. We're one step away from it emotionally, and a good advisor can do that. And these days, advisors are acutely aware of some of the behavioural challenges and can help you get through them. The second thing that I think any investor should do is just recognise the nature of investing. Things will go up, things will go down, but we should always keep our eyes on the long term. And the last and most important thing is that nature has built us to naturally focus on losses. So when we're looking at new opportunities, whether that's a new investment, a new business venture, then we should always consciously make sure that we look at the upside, because nature is always going to be dragging us to look at the downside.
For Joe, there's one other way to deal with loss aversion. In fact, it's his top tip.
I think one really simple trick is just to check our portfolio less frequently. There is this desire now to be looking at our phone, looking at our computer on a daily basis, checking the value of our portfolios, when our horizon might be 20, 30 years into the future. We just don't need to be experiencing those short-term fluctuations. So a key skill is to be able to detach ourselves from short-term market noise.
Imagine someone who has a portfolio that has 50 different things in it. If that person only looked at their portfolio once a year and they only looked at the big picture, so what is my returns over the whole portfolio over the last year, occasionally we'd see a red number. But very often my portfolio as a whole would be green. Because I'm only looking at it once a year, I'm not focusing on a lot of short-term events in between, I'm just ignoring them. And because I'm looking at the big picture of my portfolio, I'm not focusing on the individual components. Now, if that same investor was to look at their portfolio every single week and look at all 50 items, I guarantee you that every week something will be flashing red. And the myopic loss aversion kicks in, and we start to get emotional responses to week-by-week ups and downs of minute parts of the portfolio. And that myopic loss aversion, it means it draws our attention in to things that are too short-term to be relevant and too small-scale to be relevant, and yet they come to dominate our decision-making.
So, beware loss aversion. Seek professional advice, focus on the long term, consciously look at the upside, and don't keep checking your portfolio. Your future self will thank you.